Hello and welcome to Options in Plain English Advanced Edition. Today we're going to start talking about the Black-Scholes option pricing model. Options have been around for many years before option exchanges standardized and simplified options trading. One of the most difficult questions to answer back then was what the fair price of an option was. Back then, like today, options were priced based on supply and demand. In 1973, Fischer Black, Myron, and Robert Merton published a paper containing a methodology to price European-style options. Those principles are still in use today, even if the formulas are different, adjusted to address the shortcomings of the initial model. In this lesson, we're going to talk about the formula to price European-style options based on Black-Scholes. It uses the underlying price, the strike price, time to expiration, volatility, risk-free interest rate, and dividends to determine a fair value for a call and a put. We'll even show you how to build your own basic option pricing calculator, assuming European expiration-only exercise using a spreadsheet. The intent here is not to find overpriced or underpriced options, or even to be able to price them on our own. The market takes care of that based on supply and demand. Rather, we want you to have a deeper understanding of the factors that influence option pricing. Later on, you'll be able to see how all these factors come into play when determining the fair price of an option. You will then be able to look at the option market and options themselves and use them to accurately reflect your outlook on the market and achieve your financial objectives. When you go to your option trading platform and you see an underlying and you can see its options, all the different strike prices, puts, and calls, you can see the prices of those options, but who determines those prices? Option prices are determined by supply and demand via auction on the options market. So we know that those prices are determined by supply and demand. But what is the fair price for an option? In 1973, Fischer Black, Myron, and Robert Merton developed the Black-Scholes-Merton option pricing model. It uses the following factors to determine the price for a European-style option. So, a European-style option is one that can only be exercised at expiration, so no early exercise. It uses the underlying price, the strike price, time to expiration, implied volatility, risk-free interest rate, and dividends. Later adjustments to the model have been made to account for the possibility of early exercise for American-style options and the presence of price gaps. These adjustments do not modify the basic Black-Scholes-Merton findings. So there is a formula that's used by many traders, by many investors as well, to determine the fair price of an option. So options have been around for a long time, even before they were all standardized and an option exchange was first opened, which was in 1973. Back then, there was no way to determine what the fair price for an option was. For example, here, the underlying is trading at $1,452. What is the fair price for a call at the strike price of $1,470? Why is it anywhere between $38 and $46? Why is it not $100, $1,000? Why is it not $1? Well, Fischer Black, Myron, and Robert Merton developed this option pricing model to get a good understanding of what the fair price of an option was, considering all these factors. Now, this is a theoretical model of what an option price should be. In reality, when you go to the market, those option prices are determined by supply and demand. So those prices are always real prices because those are the prices that traders are actually paying. They are the prices that those options are trading at. They're being bought and sold at those prices. So those are real prices. It just so happens that this theoretical model is able to predict what the price of an option would be. And it's a pretty accurate model. It has some shortcomings, and we're going to talk about those as well. But all in all, it's a very good way to get a feel or get a sense or get a very good approximation for what the price of an option will be. Now, if the market is very liquid, those prices are going to approach the theoretical prices and get very close to them. If it's an illiquid market, the bid-ask spread is going to be very wide, and probably those prices are not going to be close to what the theoretical price would be. Now let's take a look at the actual option pricing model and see if we can understand how it works and how it considers all these factors to get a fair price for a call or for a put. The Black-Scholes model makes a few basic assumptions. Stock prices follow a geometric Brownian motion with drift. Stock returns follow a normal distribution. Stock prices follow a log normal distribution. There is no arbitrage. You have the ability to borrow and lend any amount. You have the ability to buy and sell any number of shares, even fractional shares. You have a constant risk-free interest rate, and you have a constant stock volatility. So some of these assumptions, we know that they're not true. There is definitely a variable volatility for the different underlyings. The risk-free interest rate is also not necessarily constant for the whole duration of the option. And you can buy and sell fractional shares, for example. And the ability to borrow and lend any amount is also not unlimited. But even with those assumptions not being true, the model is used widely, and it's a very good way to understand how options are priced, because they are not priced in a linear way. And sometimes if you just take a look at those option prices, they might not make perfect sense to you. And sometimes you're surprised by what those prices indicate. But by looking at the basic option pricing models, and any option pricing model could be Black-Scholes or binomial or any type of option pricing model, you'll get a better understanding of why things are priced that way. So one of the basic Black-Scholes assumption is that the returns of stocks follow a normal distribution, but the prices follow a log normal distribution. What does that mean? Well, what that means is that because the stock prices, or any underlying price for that matter, cannot go below zero, but it could go to infinity theoretically. So it could go arbitrarily to an arbitrarily high number. The distribution of prices cannot be normal, meaning symmetrical, because the underlying cannot take negative numbers. However, the returns are assumed to be normally distributed, which causes the stock prices to be log normally distributed. When you analyze a log normal distribution, you can see here that it's a distribution that extends all the way to the right, so all the way to high prices, but it cannot go below zero, which is what we see when we take a look at underlying prices. So this is a distribution that the stock prices are assumed to have. Now, whether this is correct or 100% accurate, well, there's of course some controversy, because for the most part, what you see in the actual market is that those violent moves that are predicted to happen once every 100 years or once every 200 years happen twice or three times every decade, or even more often. So you can see that what is called the tails of the distribution. So these extreme events happen more often than what the model would predict. Because of this, the way that this is reflected in the market is by skew and term structure of volatility, which together make up the volatility surface. So there's ways to account for all the discrepancies. And in this case, the volatility surface is the one that takes care of what the market predicts based on how the market actually behaves. Even with these restrictions or with these assumptions, the actual model is a pretty good indication of what the fair price for an option should be. And this is what we're going to be looking at right now. So we're going to take a look at the Black-Scholes Merton formula for European style options. So these are the ones that can only be exercised at expiration. Now, don't pay too much attention to that, because the main findings and the main premise behind option pricing is the same, whether those options are European style or American style. The American style, they just required a small adjustment, but the basic premise of how they're priced is basically the same. So this is the formula. This is how you determine the value of a call and the value of a put. Okay, so we're going to break it down. So this is what the price of the call would be under this formula, and this is the price of the put. So stock price is ST. K is the strike price for the option that we're analyzing. Sigma is implied volatility, or volatility, the volatility of the underlying. In reality, you don't really observe the implied volatility. What happens is you look at the option price, and that option price makes this value of implied volatility observable. So you can back it out of the price of the option by using this formula. So it's not something that you can observe. You can, if you want to see what the price of the call would be, then you can assume a certain value of implied volatility. But in reality, like I said, you can look at historical volatility, but that doesn't tell you what's going to happen. So this is a value that's mostly implied, that hence the name, implied in the value of the option. T is time to expiration, and time to expiration is, since implied volatility is expressed in an annualized form, time to expiration is also expressed in an annualized form. So it's the fraction of 1 year. So if you're talking about 1 day, it would be 1 over 365. If it's 7 days, then it's 7 over 365, and so on. R is a risk-free interest rate. Q is a continuous dividend yield. So for options that pay out a dividend, you convert those payments to a continuous dividend yield that could be applied to the Euler constant, to the exponential number here, to get the income stream pertaining to dividends. And that's how you get the number Q, and that Q represents the continuous dividend yield again. And the N, capital N function, is the cumulative standard normal distribution function. Okay. Now, the other factor that you see here is D1 and D2. So how do you calculate D1 and D2? Well, D1 is where you have all the different numbers, and this is a number that you can get and evaluate the value of a cumulative standard normal distribution. So basically what you have here is you have D1 and D2, but they're related to each other in a very simple way, which we're going to take a look in a little bit. So D1 is the natural logarithm of the stock price over the strike price plus the risk-free interest rate minus the dividends plus sigma square over 2 multiplied by the time divided by sigma square root of time. Okay, so it doesn't matter whether you understand how this number is going to move, but just know that this D1 number takes into account where the price is with relation to the strike price. So this is how far up or down the strike price is when you compare it to the current stock price. So this is one of the main factors here. And then the effect of interest rates, dividends, and volatility. That's going to give you the D1 number. Now, once you have the D1 number, you're going to have to evaluate it in a cumulative standard normal distribution function. So what you do here is, because it's cumulative, you take this D1 and you go and calculate the area under the curve from minus infinity up to that point. So if D1 was, for example, 1, then you would, or 1.5, which is what I have here more or less. So you would calculate the area behind the curve, or actually under the curve. And that's going to give you a number that's going to be between 0 and 1, because the total area is 1. And that number then needs to be multiplied by the stock price and so on to get the value of the call. The D2 number is it's pretty much a very similar formula. Is a natural logarithm of stock price over the strike price plus interest rates minus dividends minus implied volatility squared over 2 multiplied by time, and divided, the whole thing divided by sigma square root of time. So one of the things you notice here is the only difference is this sign, the plus sign here and the minus sign here. So D2 is always going to be smaller than D1. D2 is going to be D1 minus sigma square root of time. Okay, so based on this, there is an interpretation for this. The D1 number represents a kind of the value, the profit or the difference in your favor that you're going to get by buying a call and taking into account the probability that that strike price, that the stock price is going to end up higher than the strike price, and how much you would make. So it's the conditional probability of how much money you're going to make weighted by that probability. So basically, this is what you're going to make, and D2 represents what you're going to have to pay. When you're talking about a call, you're going to have to pay the strike price. Okay, so that's why it's what you're going to make, ND1 STE minus QT, minus what you're going to pay, N of D2 K E to the minus RT. I'm not going to go any deeper into this formula. This is just an introduction to it, but you can see all the factors that come into play when you think of how an option is priced. Now, right away, something that we didn't mention here is that the capital N of D1 is actually the delta, represents the Greek delta, and capital N of D2 is the probability of expiring in the money. So here you can see how the delta and the probability of expiring in the money are based on this function, which cannot be higher than 1 because the total area of the curve is 1. And you can see that they're not the same, although they are very similar and very closely related. Okay, so N of D1 is delta, and N of D2 is the probability of expiring in the money. So once you have D1 and D2 and you evaluate this, you can get the value for the call. And this is going to be very close to the value that you can see in your options trading platform. Again, the intent here is not to build our own pricing mechanism. It's just to understand how these options are priced and how and what they're based on when you look at a certain option price, call or put. What we're going to do now is I'm going to go to an Excel spreadsheet where I've already created all these different formulas, and I have created a little table where you put the inputs, all of these inputs, and you can get the value of the call and the value of the put. And you're going to see that actually building an option calculator is not that difficult, and we're gonna do it together, and you're gonna see, and you're gonna get the formulas, and if you want, you can build it. And I'm also going to make it available, make these these formulas and the spreadsheet itself available if you want to download it. Okay, so let's go and take a look. Okay, so we're back and we have a, in this case, I'm using Microsoft Excel. I'm using an Excel spreadsheet to develop these formulas. So as you can see, these are the formulas that we just took a look at, okay? Strike price, the stock price, N of D1 times E to the minus QT minus K times N of D2 times E to the minus RT. For the put is something similar, but just with the signs inverted. And if you have zero dividends and zero interest rate, then they're simplified, but we're not going to use the simplified version. We're going to use the full version. So we have all the different variables here. The cumulative standard normal distribution is a formula. Underlying price, strike, continuous dividend yield, the risk-free rate of return, time in days. We need to convert it to time in years. Then the formula for D1, for D2. D2 can be simplified to D1 minus sigma square root of time. And the input. Anything that's in yellow here is those are the values that we can change. And then once we have that, we just develop the formulas. So if I go here, you can see the formula here on the top. Okay. S over K is this one, C23 divided by C24. The natural logarithm of that. Okay. Then R minus Q plus 1/2 of sigma square multiplied by T is this. You have the formula here. So maybe the only difficult thing here would be the power here to elevate it, to square it. And then sigma square root of time. Sigma square root of time. Okay. So you have these components. Now you can calculate D1. D1 is going to be this plus this divided by this, which is the formula here. And you can get D2 as well. For D2, we don't need to do the whole formula because we know it's D1 minus sigma square root of time. D1 minus sigma square root of time. So we get the D2 number. Then the cumulative standard normal distribution of D1 is this. This is the Excel function for the cumulative standard normal distribution. Okay. N of D1, N of D2. And then you get the values. And you can calculate the value of a call. You develop this formula, which is here. So everything is very straightforward. Maybe the only difficult thing would be maybe the E is EXP, so the exponential number. And that would be it. It's just a very straightforward formula, and you can get the value of a call. Okay, you can copy it from here if you want, or if not, I'm going to make this spreadsheet available in Excel. And you can download it and you can do whatever you want with it. Again, the intent here is not to create an option calculator. There's plenty of them available for free. The intent here is that you understand more or less how options are priced so that you get a good understanding of once these factors change, how those values are going to change. Okay, you have the call, you have the put. And in this case, for example, I have an example, and we're going to get the value of a call, and we're also going to get the delta of a call and the delta of the put. The input, stock price, strike price, implied volatility, time to expiration. This is in years, so I'm not changing this. R, interest rate, and Q, continuous dividend yield. Okay, so for example, if I have a stock price that's trading at 200, the strike price, the 200 strike price, with an implied volatility of 80 and with time to expiration at 45 days with a risk-free interest rate of 0.2% and a continuous dividend yield of 0, so no dividends, this would be the value of a call at the $200 call and the $200 put. Okay, so this is with an 80% implied volatility. So now you can play around. What happens if implied volatility goes down? Let's say it goes to 40. Well, the values of the call and the value of the put is cut in half. Okay, so you can see that is directly related to the implied volatility. What if it goes to 20? If it goes to 20, it's cut in half again. Okay, so you can play around with these numbers. Well, what happens if it goes to 100? Well, if it goes to 100, it goes higher by a lot, right? And you can see the value of a call, the value of a put. And keep in mind, we are right at the money, and the deltas are not 50. Okay, the delta of the call is not 50, and the delta of the put is 50, which is something that we, for the most part, we assume when we want to do a quick calculation. You can see here that the delta actually depends on the implied volatility. Okay, because we're right at the money. Now, what happens if the strike price, if instead of evaluating the 200, which is the at the money, we go out of the money for the call? So we go 250. So the 250 call is going to be valued at $12, and the 250 put is going to be in the money by $50, and is going to have a value of $62. Okay. Again, what happens if volatility goes down? Well, the values go down. Look at the call. It's very, very small now. Okay, because with this implied volatility, the probability that this strike price is going to end up in the money is very small. That's why this call is going to be very cheap, because it's out of the money by a lot. Now, again, what happens if, let's use a number here that's pretty high. Okay, so we have a value of a call and the put. What if time passes? Now we have 20 days instead of 45. Look at these numbers. Okay, look at these numbers. Those numbers went down. Why? Because time to expiration now it's less. So you can see how it changes based on the time to expiration changing. Okay, and what if we increase the interest rate, the risk-free interest rate? Okay, so it would be 0.005. 0.5%. Yeah, they go up by a little, but it's not very significant. And this is something that we've talked about when we talk about which ones are the factors that are the most important for the price of an option. Okay, and you can play around. You can what if a stock is trading at $10 and the strike price is $12? With an implied volatility of 80%, what if the implied volatility is 10%? Okay, the call is basically worthless, and the put is basically worth just the intrinsic value. Okay, so you can play around with these numbers, and what happens if actually, let's say we're evaluating the at the monies, okay, and let's give it a little bit more implied volatility, and we have a dividend now. Let's say now it's a 4% dividend. Okay, look at the value of the call and the value of the put. Okay, as I change the dividends, see the call went down and the put went a little bit higher. Okay, so this is, now you can play around with these inputs, and you can figure out some scenarios in your head and see how they play out by using the Black-Scholes formula. Again, this is for European style options, so only exercisable at expiration, but it's a good indication of how they're priced in the market. You can take some of the values that you see in the market and you plug them in here, and you'll see that they're going to be very accurate and very close to what they are. Now, you have to take into account the fact that I only have one implied volatility here. In reality, at that strike price, there is an implied volatility, and then for the call and for the put, they're not necessarily the same implied volatility. And then once you go to a different strike price, it's going to be a different implied volatility. And then once you go to a different expiration, it's going to have a different implied volatility as well. So in this case, I'm just assuming that the implied volatility is flat, so it's the same for every option. But in reality, you know that the volatility surface is what determines the implied volatility for every strike price and also for every expiration. So I'm going to make this spreadsheet available, and you're going to be able to download it from my website, optionsinplainenglish.com. And I hope that this made it clear how options are priced, what the factors are that come into play when you talk about the price of an option. And also that you can see that it's very easy to create your own Black-Scholes based option calculator, and you can get a pretty good idea of what those prices are going to be as you change many of those factors. You can see how the theta affects the value of a call and a put. You can start playing with the times here. You can do many things once you have the actual formulas, and you can see that Excel has everything. So it has the function for the standard normal distribution, the cumulative standard normal distribution. It has the function for the exponential number. It has the function for the squaring a number. So you have everything here, and it's very simple. So this, I'm pretty sure, is going to make it a little bit clearer as to what factors go into pricing an option. And hopefully you found this useful. And even though you're not going to be able to apply it in your trading, this is going to give you a good understanding of how options are priced. And I hope that it did just that, and that that can contribute to make you a better trader and a more efficient one, and that it can bring you closer to achieving your financial objectives. Thank you very much for your attention, and goodbye.